Is a future in streaming services the answer for Netflix? For more, I'm joined from New York by Porter Bibb, managing partner at Mediatech Capital, who has more than 40 years of experience as an investment banker specializing in media and entertainment. Also in New York, Kevin Landis, chief investment officer at First Hand Capital Management, a prominent technology investor. Gentlemen, great to have you both. Porter, let's start with you. Netflix blowing back with great subscriber numbers today. Does that mean all of this criticism about their business model in the last few months has been unwarranted?
Well, I'm not so sure that those subscriber add-ons were great. They came in at about half of what I had projected, which was half of what their guidance was last quarter. They suggested they were going to have 800,000 new add-ons. I said they would be lucky to get 400. It's closer to 200. So the growth story that Corey was talking about is definitely not there.
Now, Kevin, you say Netflix is unappreciated. Listening to what Porter has to say, how do you respond to that?
Well, look, the number one thing that Netflix has to protect is the relationship with their customers. And we saw that when that's put in jeopardy, it kind of shakes the foundation of the whole company. So the fact that they're growing at all, the fact that they added subscribers at all, that's a good thing. They made money. That's a good thing. So it's a step in the right direction after some, missteps last year. But no, I think you've got over 20 million subscribers, and for the most part, they're happy. They stay there. They're loyal. And that's something you can build on. They've got obviously some big challenges in that on the streaming side of the business, people are asking them for a lot of money, and it's really changing the financial model. And I think that's the next thing you address. But you can't even worry about that if you've got your customers leaving. You've got to make them happy first and foremost.
And that's going to get more and more expensive. And I'm not sure I buy into the story that Netflix can replicate the HBO model. Reed Hastings said HBO was his prime competitor. I don't see that because they've got 40 years of history and experience turning out very high quality product. He's got none. And it's really going to be his ability to continue to buy quality content from the networks and the studios. And as everybody knows, those prices are only going to go higher and higher and higher. And at some point, Netflix is not going to be a sustainable business model.
Kevin, do you agree with that? The content, the cost of the content is really the wild card here, and it's going up. Can Netflix continue to grow and have the best stuff?
Well, think about this. When you watch your favorite TV shows, at the end of it, there's a rapid-fire succession of 3 or 4 different production and distribution companies that come along. Yes, it's an HBO thing, but it was bought from so-and-so, who then bought it from so-and-so. So ultimately, there's a lot of intermediaries between the viewer and the original artist. So, the companies right now who believe that they own the content, they're just the people who bought it and developed it and brought it along.
But they're also the people who set the price that Netflix has to pay to license it.
That's right. But if you take a show like, for example, my current favorite TV show, Breaking Bad. Breaking Bad is a big hit on cable, but originally it was shopped around, and it was shopped around to many different networks. I think the next show that comes along, Netflix will be one of the places where they shop it. And so people will have to figure out, are you downstream of me, or are we side by side? And you're right, we have to come up with a dynamic that allows everyone to make money, or else
where do you think the money that Corey mentioned that's off balance sheet, their liabilities, the license fees that they owe the studios and the networks for movies and shows that they've already licensed and are now running, where is that going to come from with the disparity between the liabilities of over $2 billion plus and only a couple of $100 million in cash?
Right, that's tough. You're right. They couldn't pay for that out of existing cash on the balance sheet. And if they don't manage it right, that'll become the next equivalent of what happened with Blockbuster when they had a bunch of leases on real estate that turned out to be just an anchor on them.
Well, we know who bought Blockbuster. Who buys Netflix?
Well, look, there's no question if they mismanage it, we all know where that road leads. I'm just saying they have happy customers right now. They can possibly manage this properly. And I think if you wanted to create another company that has 20+ million happy paying customers, that'd be a tall order. And so Netflix has got something that's of value.
And Porter, you don't think Netflix will be an independent company by the end of this year, right?
I don't think their business model is remotely sustainable, and the idea, their $5 billion market cap right now is probably equivalent to what the customer acquisition cost of 20 to 25 million subscribers would be for anybody who's thinking about buying them. And I'm predicting that Yahoo will probably step up before anybody else does.
All right, gentlemen, we'll have to leave it there.
Right.
Porter Bibb of Mediatech Capital, thanks for joining us. Kevin Landis, you'll be sticking around.